SpaceX is preparing for an initial public offering with a target valuation of $1.75 trillion, the largest in human history. This animated diagram illustrates exactly what $1.75 trillion looks like. That single valuation is larger than the combined market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks. You could take the top 10 most valuable companies trading on the London Stock Exchange, add them all together, and they would still fall short of that number. But the consolidated company carrying that massive price tag is currently losing about $5 billion a year. This gap between the target price and the actual profit margin suggests this IPO is operating under a different set of rules. To understand why anyone would buy into a company bleeding $5 billion a year, we have to look past the hardware and audit the three very different businesses living inside the same company. To understand how the public is being routed into this offering, we have to look closely at the corporate structure. SpaceX actually operates as three distinct businesses stacked on top of each other. The first is the rocket division. It launches government satellites and cargo missions to space. It commands almost all the media attention, but last year it only generated about a quarter of the company's total revenue. The second business is Starlink, a satellite internet provider. This is the actual financial engine paying the bills for everything else. Looking at this line graph, we can see exactly why. Starlink recently brought in over $11 billion in annual revenue, and its profit margins have rapidly expanded from 41% up to 63% over the last 2 years. High revenue and accelerating margins make Starlink an incredibly strong business, but its success on paper provides the necessary cover for the immense financial drain occurring in the third division. That third unit is xAI. A few months ago, SpaceX acquired the Artificial Intelligence Lab in an all-stock deal that assigned the AI company a standalone valuation of $250 billion. Inside that lab, the operation is burning over $1 billion every month. By March of this year, all 11 of its original co-founders resigned, prompting the CEO to publicly state the entire asset had to be rebuilt from the foundations up. This comparative bar chart shows the stark reality of that price tag. OpenAI generates around $24 billion in revenue against an $850 billion valuation, and Anthropic does $30 billion against a $400 billion valuation. xAI generates an estimated $1 billion, yet carries a $250 billion valuation. Consolidated into the balance sheet, xAI consumes the rocket and satellite profits, leaving SpaceX with a $5 billion loss. The internal math of these three divisions fails to support a $1.75 trillion valuation on the open market. Getting investors to buy in at that price requires altering the mechanics of the market itself. This brings us to a quiet change in the financial plummeting. Recently, the Nasdaq Stock Exchange adopted something called the Fast Entry Rule. This new Fast Entry Rule compresses the 3-month price discovery window to just 15 days. The exchange also removed its minimum float requirement, allowing SpaceX's tiny 4% float. Finally, a hidden multiplier legally treats that small float as 3 times larger. These adjustments were not made in isolation. They form a customized regulatory environment designed specifically to accommodate a highly anticipated pipeline of massive, unprofitable tech and AI companies waiting to list. The exchange systematically rewrote its listing requirements to engineer artificial, guaranteed demand, creating a paved runway for an unprofitable company to list at an impossible valuation. That engineered demand directly connects to the $600 billion in passive investment capital that mechanically tracks the Nasdaq 100 index. The supply side of the IPO is highly targeted. The chief financial officer recently confirmed they are heavily allocating the offering toward everyday buyers, aiming to place roughly 30% of the available shares with retail investors, explicitly citing their long-standing loyalty to the company's founder. Because of the updated Nasdaq guidelines, passive index ETFs will automatically start buying up these shares without any human intervention. The mechanics of passive investing ensure the stock drops directly into index funds held inside everyday 401ks. The timing creates a very specific transfer of capital. The rigid timeline forces index funds to purchase the stock early at its absolute peak valuation, generating the billions of dollars in liquidity needed for corporate insiders to eventually sell their early low-cost shares. Slowing down. Serious turn. Passive investing became the default strategy for the middle class, because it offered low fees and automatic diversification. But the exact same mechanism that makes an index fund run on autopilot has been turned into a tool. Today, retirement accounts that absorb these shares without question serve as guaranteed exit liquidity for highly unprofitable megacorporations.